Welcome to RBC's Markets in Motion podcast, recorded May 8th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, we've lifted our 12-month forward S&P 500 price target to 7,900, which represents a 7.7% gain from the May 7th close. In adjusting our forecast, we're focusing on our valuation and earnings model, which we think does the best job of baking in a two-speed economy and earnings backdrop. Second, on bigger picture positioning, we continue to prefer growth over value, U.S. over non-U.S., and like small caps, just not quite as much as large cap growth. Our sector views are mostly unchanged, but we have lowered healthcare to market weight from overweight. Third, we run through strong stats from 1Q26 reporting season. If you'd like to hear more, here's another 5 minutes. Takeaway number one, we have lifted our 12-month forward S&P 500 price target to 7,900, which represents a 7.7% gain from the May 7th close. In adjusting our forecast, we are focusing on our valuation and earnings model, which gives us the best way to bake in a two-speed economy and earnings backdrop. My apologies, but I need to go through some math. For our PE calculation, we bake in macro assumptions for 1Q27 that are more onerous than consensus. 3.3% CPI and 4.5% 10-year yields. This takes the implied trailing PE down a bit from the highs of the past year to about 24 times. Meanwhile, for earnings, we take the bottom-up consensus, trailing 4Q for 1Q27, and lower that by 5%, which takes the expected growth rate year over year down from 18% to 12%. So why did we pick that 5%? We took the S&P 500's consensus net income forecast, dividing it into an AI basket and an XAI basket. We left the consensus forecast for the AI basket unchanged. The forecasted growth rate of that cohort, by the way, is 28%, the fast lane in our two-speed earnings backdrop. For the S&P 500 XAI basket, which we think is more at risk from Middle East impacts, we took the consensus forecast for 1Q27 and lowered it by 7.5%. That's the slow lane, as our adjusted forecast for that cohort ends up being about 6%. The end result of all that math, putting the XAI and the AI back together, results in a fair value estimate for the S&P 500 of 79.29, which we round to 7,900 to set our new target. Note that we do see some upside risks to our view. The median and average of the 5 models we normally use to set our target is around 8,100. The median output comes from our sentiment model based on AAII net bulls. Net bulls have been rebounding, but are still a little below average. When net bulls are between average and one standard deviation below average, the S&P 500 typically moves up 10.8% over the next 12 months. 2 of our other models are looking for even higher returns in the 13 to 14% range. Note that we don't think the path will be linear for stocks and that pullbacks are likely. That is a nuanced view, not a bearish one, as we continue to have one of the higher price targets on the street. But as long as recession fears are held at bay, we expect pullbacks to be no worse than 5 to 10%. Moving on to takeaway number 2, bigger picture positioning. We continue to prefer growth over value, U.S. over non-U.S., and like small caps, again, just not as much as large cap growth. On style, we think performance will chase earnings and see stronger earnings growth forecasts and rates of upward revisions in areas like big cap growth, the Mag 7, and again, those AI-related stocks. On U.S. non-U.S., relative valuations, which helped get the shift back into the U.S. started, have been on the rise, but they don't look alarming for the U.S. yet. On small caps, we're keeping a close eye on valuations, but think positioning still looks favorable. On sectors, our views are mostly unchanged, but we have lowered healthcare to market weight from overweight. Valuations remain attractive in our view, but earnings revision trends are weak, flows are negative, and the sector was middle of the pack on most of the questions in our April Analyst Outlook survey for the U.S. And finally, let's wrap up quickly with takeaway number 3, recapping 1Q26 earnings. There's one particular stat we think we need to highlight. When we look at the expected earnings growth rate for 1Q26, it started out with a 13% consensus forecast, and it's now tracking at 26%. Other quarters in 2026 are not seeing such a parabolic jump, but they have moved up. So the strong earning tailwinds are not just a 1Q surprise story. When we look at recent changes in anticipated 2026 EPS growth rates, the year as a whole, Technology, energy, and materials are the ones that have seen big upward revisions and also have higher anticipated growth rates than the S&P 500. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.